afternoon, everybody. Hopefully you can all hear me loud and clear. Welcome to what is our first UHY budget webinar. I think hopefully you should have all received via email our budget press release this morning. In line with our purpose of helping you prosper, we brought together a team of experts to assess what yesterday's budget announcement means for you as individuals and business owners, and that in turn that we can then help you prosper going forwards. We're going to look at some of the key elements of the budget, but also look at maybe what wasn't included and what there might be arriving in the future. After what was a tax raising budget of 2024, some elements of which have not yet hit us, it had been hoped that the government, that they wouldn't apply tax increases going forwards, but looking at the 25 budget, this doesn't appear to be the case. The 25 budget is probably going to affect the vast majority of households, both individuals and businesses. But when Labour came to power, they constantly said that they would not raise income tax, VAT, or national insurance. And to a certain extent, they've stuck to that promise, I think. They haven't raised either of those taxes, but Rachel Reeves has delivered a tax-raising budget where she actually said that the ordinary people will have to pay a little bit more. But that little bit more is estimated to be £26 billion in tax rises by 2930. Now, to my mind, that isn't a little bit more. That's going to be some significant tax hikes over the next few years. So all of us, therefore, are going to pay more in tax. There were winners. There were losers. I think the most notable loser might be the individual who accidentally released the OBR report prior to the Chancellor standing up and releasing details of a number of key elements. I wouldn't like to be standing in his shoes at this moment in time, and in fact, he may not even be in the office anymore. The biggest obvious impact announcement was the freezing of the tax thresholds, first introduced by Rishi Sunak back in 21. And if this now continues as planned, will result in 10 years of threshold freezes. Other losers include the additional tax rates on property income and savings, and of course, the new mansion tax. But were there any overall winners? Well, at least the budget probably wasn't as bad this year as it was last year. And I think the general perception is that it appeared to be a relatively fair budget. But on a serious note, there were some minor winners. The national minimum wage was increased. For those 21 and over, it went up 50 pence to £12.71. For those 18 to 21, it went up 85 pence to £10.85. And there's a moderate 45 pence increase for those under 18. But this might not be good news for those involved in the service industry that use the national minimum wage as a benchmark for salaries, as rates of pay will probably have to increase, which in turn is going to have to be passed on to the consumer. There was the removal of the two-child limit so that families receiving the child element of the universal credit will receive that regardless of the number of children in the family. This is going to have a positive impact, though. It's going to lift some families out of the poverty trap. Then there was the increase in state pension and the new state pension. These are rising by £440 for the basic state pension and £575 for the new state pension. And these are as a result of the triple lock, which guarantees that pensions will rise each year by a minimum of 2.5%. And finally, we're all going to be better off by up to £150 because our energy bills are apparently going to be going down due to cuts in the cost of living. But in addition to what I call direct cuts, the OBR predicted that the UK economy is going to grow by 1.5% this year, which is an uplift from the 1% forecast in March. And this, to a certain extent, I think is really positive as it indicates that Britain is growing. If Britain is growing, then we all tend to benefit. However, whilst the prediction for this year has been upgraded, the forecast is only that the economy is going to grow by, on average, 1.5% between 26 and 29. which has been downgraded from previous estimates of 1.8. So are we therefore going to be looking at a bit of a slowdown in the economy post-26? But then the inflation predictions are also looking good. The average is 3.5% this year, falling to 2.5% next, and returning to a government's 2% target in 27. Now, if this does happen as predicted, this is probably going to have an impact on businesses because wage rises may come under control, meaning they won't be as high. And in response to Rachel Reeves' budget, Kemi Badenoch called the budget a smorgasbord of misery. And to a certain extent, I think there is probably a little bit of misery in the budget for everyone, as we'll see later on. How much are we all going to be paying will depend on your own circumstances, but the revenue-raising measures announced yesterday are in part more by stealth rather than by direct tax. There were winners and there were losers, and hopefully over the next 45 minutes or so, we'll discuss some of those measures that will impact you and your businesses. If during the discussions you want to raise questions, there is a chat box within Zoom. If you want to put your questions in there, if we have time at the end, we will then go through those with you whilst we're on air. If we don't have time, we'll then drop you an email after the event answering all questions. So now let me just introduce everybody that's on the panel today. Firstly, we've got Sandra Jeevan, who is head of our private client team, and Sandra is going to be discussing with me various aspects of personal and capital taxes. We then have Ian Dickinson, who is corporate director, and we're going to be discussing with him changes to business tax together with some of the investment relief changes. Then we have Sean Glancy, who heads up our VAT team, and he's going to be looking at changes to VAT and other taxes. And finally, for those that don't know me, my name is Richard Stanley, and I head up the tax teams for London and Nottingham. So, given that the impact of the threshold freezes will affect all workers, let's first go to Sandra to understand more. Sandra, people will have heard that there were no increase in income tax rates, but perhaps don't fully understand the impact of the threshold freezes. Maybe you can just elaborate on this for us.
Thank you, Richard. Good afternoon, everyone. Yes, let's unpack what that means. The income tax hike was the most feared change in anticipation of the budget. And like you said, whilst she did not increase income tax rates, the freeze and thresholds has a significant impact on individuals over time, often referred to as the fiscal drag. This means that with every pay rise, more people will be paying more tax, tipping more individuals into paying higher rate tax. If the freeze continues from its inception, like you mentioned, Richard, in 2021 through to 2031, the overall tax take over the decade is estimated by independent analysts to be in the region of 50 to 60 billion. Now, let's put that into context. What does that mean for the individuals? So, for example, if we have someone earning £50,000 per annum today, that individual will be paying tax at, will be paying around 7,500 in income tax. If then we say their salary were to increase in line with inflation, but thresholds stay frozen, their tax bill will jump to 13,500, an extra 6,000 without any tax change. And that's huge. It's not just tax on earnings that are impacted. When you start paying higher rate tax, your personal savings allowance are also impacted. And if you're an additional taxpayer, your personal allowance will also be impacted. So it is quite a lot.
Okay, but if we hadn't had the threshold freezes and the thresholds had increased in line with inflation, so that's the basic rate band, the 40% band, and also the personal allowances, do we know what they might now be had they gone up with inflation?
Yeah, it's anticipated if it did increase in line with inflation that the basic rate bands should be in the region of 60 to 70,000 as opposed to where it is at this point.
So that's actually quite a significant jump, and therefore we can see why that raises significant amounts of tax going forwards had they, not frozen these thresholds. And what about the new 2% tax increase on savings and property income? What's happening here?
Yeah. So it was also announced yesterday that from April 2027, property income will be taxed at higher rates. So 22% for basic rate taxpayers, 42% for higher rate taxpayers, and 47% for additional rate taxpayers. Now, the point to note here is it applies to individuals and it is not applicable to properties that are held in companies or within trust as well. The same uplift applies to dividends and savings income. However, there will be no movement to the higher rates of dividend, the dividend rate band of 39.35%. So the movement will be at basic rate 8.75 to 10.75, and then 33.75 to 35.75. Now let's move back to the increase in the property rates. At first glance, the 2% point increase appears modest. However, once Section 22 is applied to landlords, the effect on real world cash flow becomes far more significant. Now, let me elaborate a little bit on what Section 24 is. Section 24 implies that tax for landlords is calculated on a profit figure that ignores mortgage interest, and they only get a separate deduction of 20% tax credit as opposed to the entire relief. So this means that even a small increase in tax rate can translate into a substantial reduction in spendable income. Landlords' net annual income could significantly reduce. Now, let's just take a fictitious example and imagine or use this example where you have a landlord that owns 8 properties and receives net rent of about 115,000 for the year. The properties are leveraged, so the landlord has a mortgage of £1 million spread across these properties. Now, pre-changes, so pre-April 2027, their post-tax profits could come to 13,000. And post-changes, this will reduce to 11,000. So in this example, a 2-point increase could result in a 14% reduction in cash flow.
Okay, so what impact do you think this might have on landlords? Will they start to sell properties and invest elsewhere, or what do you think might happen?
Yes, I suppose the one thing that property owners, or especially when you have properties for investment purposes, the one thing they will always consider here is incorporation. Is that the right thing to do? And it does seem like an attractive option because the rates for corporation tax have not increased. However, this is a complex decision with significant pros and cons to weigh. And I would strongly recommend consultation, as this needs to be dealt on a case-by-case basis. Some of the considerations that we need to be thinking about is the impact on entry. So are there any tax charges on entry? If the properties are leveraged, the SDLT implications. We might want to think about ATAP implications and profit extraction, which Ian will be covering in his section.
Okay, thank you for that. Obviously, Rachel was talking about the simplification of tax, and I've just worked out actually that we now potentially have something like 9 income tax rates that go from 10.75%, 20%, 22%, 35.75, 39.35, 40, 42, 45, and 47. To my mind, that is not simplification. That is making it a lot more complicated.
And a lot more for the software developers to take into account.
Exactly. Okay, so Sandra's just mentioned that landlords might look to incorporate their property portfolios. Ian, is there an opportunity for landlords to shelter property profits through limited companies if the corporation tax rates haven't changed?
In one simple word, sorry, good afternoon, Richard. Yeah, simple word, yes. If you look at it on the very basic premise that whilst the main headline corporation tax rate has stayed at 25%, we do still have a 19% rate, which when you compare 19 to the potential 22% lower rate for individuals, is a headline, yes, that's an incentive to look at it. Now, incorporation of rental properties into companies is something that's been on, should we say, the tax advisors and clients' agendas for nearly 10 years now, since they introduced the restriction of mortgage interest relief. But I think, as Sandra said, it's never as easy as you might think. You've got to consider the tax charges of getting the properties into the company, the SDLT things, but the main one that we see is the problem in this is when clients have mortgages on their properties. Interest rates are what they are now. They're not as generous as they were a few years ago, so people may be locked into mortgages. If they try and incorporate, the company or the bank is going to want a new mortgage with the company. So you have the dilemma: do you get off the good mortgage rate you're on to get it into the company for the future tax savings? There's a whole myriad of things. So there's no easy fix, but it's certainly something to look at.
Okay, and given that there was no increase then in the corporate tax rates in this budget, how have companies and business owners been treated this year by Rachel? Many were expecting more of a focus for entrepreneurs. Has that happened? Have they got any investment reliefs available, etc.?
Yes, there's various things that will be coming in the future, but in terms of the headline rates and the whole general corporation tax environment, as we know, the main rate stayed at 25%. What the UK tends to do in its tax system is it uses this high headline rate to be comparable in the EU with other countries, but they like to use incentives and other reliefs to target spend and activity in the UK, which leads into hopefully promoting that growth idea, the mythical growth concept. Personally, I deal with recent research and development tax relief, and that's an incentive that's had a turbulent few years, but it's still very much alive. And this is a way that, again, the government try and encourage UK investment, UK activity to reduce your headline rate down to a more palatable, effective rate. Just looking at some of the, I suppose, the impacts on business in the current budget, there was obviously the national minimum wage increase, which is another cost to employers, which added on to the change in the 2024 budget around increased NIC, makes it very tough out there. So there's no good news for employers, unfortunately.
But what about this new rates of first-year allowances that were perhaps announced for businesses?
Yes. Now, I've been in tax 30 years, a bit of a cynic. This is a bit of a, I would call it a good spin of the way it was announced. For those that were listening, the Chancellor announced we're going to introduce this new 40% first-year allowance, which on the surface, everybody thinks that's great, that's good news. She then politely glossed over the next line of it, which was a fundamental tax increase for companies in relation to the reduction in the writing down allowance rate for their capital expenditure. There's lots of technical details, but there's a tax increase there on the back of it. The first year allowance in itself, yes, it's on the surface, it's a good idea. It's for promoting spend, again, trying to increase growth. You're going to get a 40% tax write-off upfront for certain types of expenditure. Feeding back into your comment about the winners, my challenge is I don't think there are that many winners that this will impact. Due to changes in recent years, we have a £1 million annual investment allowance where you get an immediate tax write-off for your capital expenditure. And we also brought in full expensing, which again is a sort of a top-up to that. So in reality, there aren't that many companies I don't think will spend more than £1 million a year and not benefit from that and the full expensing. So that said, there are some winners. I do have 2 clients where this 40% may be a good attraction, so I'll be getting in touch with those very shortly. It's a bit nuanced, but this is when a company buys assets that then leases out to its customers. So in the past, they weren't able to benefit from this full expensing relief. And Jeremy Hunt's last budget actually said that they were going to consider extending this full expensing for these companies that use assets for leasing, but it was when fiscal conditions apply. So Rachel Reeves has obviously decided one of the advantages, one of the incentives she wants to do is to say, well, I won't extend it as 100%, you can have 40% rate. One other quick thing on that 40% first year allowances, the other winners are those unincorporated businesses because they can't claim full expensing. They have only an investment allowance, but they can't claim full expensing. Again, the dilemma in that is you need to be an unincorporated business spending more than £1 million a year on plant and machinery. Again, perhaps few and far between.
Okay, so on the one hand, we have a new first-year allowance that is very narrowly drafted in terms of the businesses that it will actually apply to. But on the other hand, we have a reduction in writing down allowances that are going to affect every single business by a reduction of 4% in the writing down allowance.
Yep.
Okay. Not very good for businesses. But what about attracting investment in business? You know, we've heard about VCTs, EIS, etc. What has happened there with those?
So I mean, we're coming up to Christmas. They're sort of the gift that will arrive in the future. There was an underlying theme that the Treasury have been putting out. This is all about a budget for entrepreneurs to try and incentivize, and again, to build on that idea of being tax incentives. So a few of those acronyms you mentioned, we love acronyms in tax. There are changes around EIS, EMIs, VCTs, EOTs. The EIS and the VCT are more directed at individuals to encourage them to invest in new startup companies, innovative companies, where you can basically get a reduction against your tax bill if you invest in these specific companies. Changes to EMI are more about a specific regime to involve giving incentives and share options to your people. So there's a bit of hope out there, but I say it's coming. What they've really done is they've broadened the accessibility of these reliefs. So in the past, there were certain limits. You only had targeted specific small companies. They've extended those limits. So hopefully, if you look and speak to your advisors, there may be opportunities for you that may have been turned down in the past.
Okay, but I understand they may have extended the limits, but with VCTs, have they actually reduced the rate of tax relief on them?
Yep. Again, this is one of those devil in the detail that we always say when we do these things. They've extended the limits, they've given you more scope, but the VCT relief was 30%, it's now 20%. So yeah, always check the details.
Okay, good. Sandra, I talked about in my introduction about some of the losers from yesterday's announcements. Let's move back to some of the other announcements impacting individuals. And what's your take on the newly introduced high value property council tax surcharge, or mansion tax, as we tend to call it, for owners of property in excess of 2 million? Can you give us more detail?
Yeah. Yes, Richard. Let's try and unpack this one because, yes, certainly fulfills the loser category here. From April 2028, Rachel announced that the high value council tax, which the public predetermines as the mansion tax, will be introduced. The charge will be based on updated valuations, and there will be a consultation period from April 26 to try and band these or try and value properties so that they fit into bands, and more so to identify properties that are above the thresholds. So this will be an additional tax to the current council tax the properties pay. The new charge starts at 2,500 per year, rising to 7,500 per year for properties above 5 million. So there are actual bands here. We've got the 2 to 2.5, and then 2.5 to 3.5, that will be 3,500. 3.5 to 5, that will be 5,000. And then, like we said, the over 5 million will be 7,500. Now, unlike what I said about the increase in rental income, which is only applicable to individuals, this high value council tax also applies to properties that are held within companies and trusts. So there are, again, as part of the consultation, there will be measures to introduce to unpick these complex structures where properties are being held. And also the tax is applied or levied on property owners as opposed to the occupier, and it's per property. So if you have a property that is owned by, say, 3 individuals or 4 individuals, that high value council tax will be split among the individuals that own that property, as opposed to each owner having to assess the value of their property. Now, what concerns me here is the greater economic consequences beyond the chancellor's tax grab, because this could leave £2 million homeowners who have a mortgage to potentially slip into a negative equity as prices align. The government has announced as well that part of the consultation, there will be measures to evaluate how the deferral scheme could work. So previous reports had indicated that homeowners will be able to defer the cost until they die or move house to avoid forcing them to sell up, because you will have lots of owners who are asset rich but cash poor.
Okay, so granny that lives in a £3 million mansion only has a state pension, won't have to necessarily pay it. It can roll up in time. Okay.
Yes.
I see a couple of issues with this. One is that in respect of landlords that have high value properties that they rent out to maybe multiple occupants, their costs for that property are going to go up, which is probably also going to get passed on to the tenants themselves, I suspect.
Yes, because without we talked about the fall in cash flow with the rise of rental income. Yeah.
And the second potential issue is on selling and buying properties and valuations, and those people with properties that hover around the bands are going to come in at certainly under the band or buy just under the band as proof that they have a property that's less than £2 million. So I suspect property valuers are going to be in high demand sometime in the future.
Yeah, and I also anticipate that HMRC is going to have more scrutiny on valuations at this point.
And do we think that £2 million band is going to change in the future? Because we've seen with other taxes that band that may have started out at 2 million is now diminished into a much smaller figure.
Yeah, you're quite right, Richard. With ATAT, when ATAT came in, it was a lot higher than it is right now. It's dropped right down to 500,000. This may be a measure for the government to put to introduce a system of monitoring, and further down the line, it'll be easier then to reduce these bans and more people will be susceptible to these charges.
Yeah. Do you think this could be a precursor for a wealth tax that everybody thought might come in?
Yes, it's disguised in a way.
Okay.
Yeah.
And so talking about wealth taxes, weren't there some tax changes announced to agricultural property relief? And aren't there some measures that were in last year's budget that are still to come in 26 and 27?
Yeah. So let's talk about the acronyms again. So agricultural property relief, also known as APR, and business property relief, known as BPR. Rachel announced that the forthcoming combined allowance for the 100% rate of relief will be fixed at 1 million until 5th of April 2031. Now, when she first introduced the cap of the 1 million in 2024, it was also said that the 1 million ban was not transferable between spouse and civil partners. This has now been overturned yesterday, and subject to availability and conditions satisfied, the 100% band can be transferred to spouse and civil partners, including if first that was before 6th of April 2026. Now, transferability means that a couple can effectively shelter 2 million of 100% relief, but only if both estates have qualifying assets at the point of death. So that's the critical takeaway here. Ownership period and the business nature test remain critical, and reviews need to be done to confirm availability. The way the draft legislation is currently worded, relief is applied before the allowance is transferred to the surviving spouse.
Okay, so with such things as APR and BPR, then presumably if business interests are only in one spouse's name, then we need to look at whether or not those business interests need to be transferred into joint ownership so that at least that 100% relief can be transferred.
Yes, certainly. Like I said, I mean, it has to be qualifying for the individual owning it. Yes.
Okay, and one of the other announcements in the last year's budget was to do with pensions, because that hasn't.
Yeah. I'll touch on pensions, but before we go to pensions, let me just talk about some of the changes that you pointed out that were introduced last year. So these changes on APR and BPR and the 1 million cap is only going to take place from 6th of April 2026. So we now have a window of opportunity to take some action and planning and use some of the grandfathering provisions of the 100% relief, the 1 million cap. Planning should seriously be considered, especially if succession is something you would like to explore. And this can be done by, exploring the use of a family trust or creating long-term investment structures using family trusts and family investment companies while ring fencing the 100% relief. I would certainly recommend conversations. Again, this is all case by case, and careful consideration needs to be given because it's a complex area. Now, it is also worth noting, and this is a particularly interesting one, that consideration needs to be given to trusts with BPR qualifying assets, as these trusts would not have previously had a 10-year charge due to the 100% exemption of BPR. But what will happen from 6th of April 2026, these trusts will now face 10-year charges. And this could be again a situation where a trust contains shares in a BPR qualifying company, not cash rich. So how do you then fund these things? You certainly need to have conversations around these topics.
Okay, and then what about the pension changes?
Okay, so with the pension changes, these changes are due to come into play from 6th of April 2027. And this caused a big upset for lots of people because previously pensions could sit outside your estate. However, from 6th of April 2027, what this means is any unused pension fund will be included as part of the individual's estate at that. So that could be quite significant for some people.
Okay, yeah. So I've looked at some examples of this. So effectively what's happening now is that whilst pension pots were outside of a person's estate from April 27, they're going to be chargeable to inheritance tax. Now, the good thing is the IHT can be paid by the pension scheme. But if you had a £1 million pension pot, that could have gone to your beneficiaries IHT free, and then the beneficiaries would pay income taxes and when they draw it down. Going forwards after 27, the pension pot will initially be charged to inheritance tax at 40%. So on our £1 million pot, 1 million goes down to 600,000 because we've paid 400,000 in inheritance tax. If your beneficiaries then wanted to withdraw all of that out in one go, that would suffer income tax, which means the net effect is that out of our £1 million, the beneficiaries only walk away with about 360,000 or thereabout. So it's quite a significant,
extremely significant. Yes.
And we are looking at ways in which that can at least be mitigated by what we call regular gifts out of income.
Cool.
Fantastic.
Yeah.
Ian, another announcement whilst we're on the subject of pensions that they mentioned in this budget related to pensions was the £2,000 cap on salary sacrifice. How's this going to impact business owners and individuals?
Unfortunately, the obvious answer is not well. It's a tax increase. Fundamentally, salary sacrifice, where you give up some of your salary, which means it won't be subject to national insurance, employers and employees, they're going to cap that. So they're going to cap the rate of contributions can be made and benefit from that NIC saving. Just to avoid any confusion, the tax relief on pensions still applies. There was a lot of rumours beforehand whether we're going to lose high rate tax relief on pension contributions. Don't worry, that's still there. This is all about national insurance. It's probably going to impact not the lower middle earners, it's really the higher earners. So whilst I said you still got your high rate tax relief, this cap will be probably impacting the higher earners. Just a quick illustration on that, I suppose. If you've got a £30,000 salary, 6% employer contributions, you won't see any change impact on you. There's no impact of this cap. if you've got £70,000 salary, 6% contributions, you will start to see an impact of it. So overall, there's a cost to the employer. One bit of good news, we've got till April 29. So this is another change that's going to come in the future. So there's time to plan for it. So one thing you might be thinking is, why don't I just put loads of money in the pensions? Yes, that's always a good idea, putting money in pensions. But again, cynic of 30 years in tax says, don't forget, Sandra just mentioned the IHT changes where pension pots come into inheritance tax. So it's certainly something of the whole package to look at, how you take out money from the company.
Okay, and just like an aside to that, a lot of business owners that we act for and that we see tend to have a mixture of salary and dividends now as part of their remuneration package. How will the increase in the 2% increase tax on dividends affect whether or not we're having salaries or dividends or a combination now?
It will make the myriad of calculations we have to do more relevant. Since corporation tax was increased to 25% 2 years ago, the sort of band of whether it's better to take dividend or salary moved to get very close. That it depends on specific cases whether dividend or salary is best. These changes of the 2% tax on dividends is actually even pushing it further towards potentially, probably, salary being more efficient. Obviously, you then have NIC on that, brings in a myriad of factors, but the whole year-end planning, the whole idea of it being dividend is always better, is sort of gone out the window, and it's very much look at every case on a case-by-case basis.
Okay, thanks for that, Ian. Sean, let's now move to you. Were there any key VAT or duty announcements in this budget, and were you surprised that there perhaps wasn't a bit more?
Yeah, I was surprised it wasn't more, but then that has been the history of VAT and budgets. A lot of the stuff that we have to deal with is dealt with behind the scenes, I guess, through policy changes and things like that. There were 4 things that I picked up that I thought were of interest. They are quite niche, but I think they are important. So one was the change to private hire vehicles, so use of apps basically to book cabs. Second one for charities, there's a minor relief been brought in. Changes to e-invoicing, so VAT invoices, which all businesses will be affected by. And then also low value imports relief, changes to that. So if I can just skip through those quite quickly, as conscious of time. So we've had a long running issue with private hire vehicles in VAT, been running for 30, 40 years. With the arrival of apps, the issues are magnified. And at one point, if you booked a cab through an app, there was no VAT paid for at all, because there was some way you could structure the arrangements, which was legitimate. It's just that the legislation hadn't kept up with technology. HMRC challenged that with one leading app company, and I think the app company at that time settled for about £800 million. And I think that gives you on one company the scale of the issue for the revenue and what that means for Treasury. What in this budget they've announced is that they won't be allowed to use a margin scheme. They won't be allowed to use a tour operator's margin scheme and account for VAT on their commission. They have to account for VAT on the full amount received. That is, though, in conflict with some cases from the Supreme Court, which says that those rules don't have to apply outside of London. So a bit of a mess. They are doing, I guess, their best to tighten up what they see as a loophole. But then if you're in the position of the cab company, the app company, their margin, their profit might be 20%. So prices will have to go up to compensate for that loss. So that's going to be something that's, a very sensitive commercial issue, but it needs to be taxed. It needs to be sorted out. For charities, there's a minor VAT relief following a consultation. I'm surprised how limited in scope this is. Basically, business donations of goods for charitable purposes will no longer attract VAT, which is good news, but you could have done a lot more. Big change in 2029. You're going to have electronic invoices issued. This follows and is very common in the EU now. We are miles and years behind other European countries. In Italy, Spain and Portugal, they do real-time reporting. In France, that's just been introduced, and they've introduced VAT in a digital age. So lots of mandatory computer-based accounting, including real-time, as I mentioned. And you can see what that leads to in terms of compliance. So if you're doing everything on computer, everything else, does that give the revenue access to that information? And when you move to real time, there is a counter fraud check in there, which is really important. But also then a kind of almost routine checking from HMRC, the UK authorities. So interesting where to see that ends up. And then there's been a lot of contention around low value imports and distortion of competition. This was attempted to be fixed following Brexit in 2021, not entirely effective. In fact, made the rules very, very complicated. But from 2029, they're looking to remove this low value importation rule, which will benefit UK businesses because they'll be in a better place to compete with overseas businesses subject to the same rules, essentially. So those are the kind of the things that kind of leapt out at me just from the budget.
Yeah, okay. Do you think there's anything that could have been further done to the relaxation of child benefit cap that could have helped with the relieving of child poverty and VAT?
Yeah, I think the thing for me is that it's clearly quite an important policy for Labour, for the government, to relieve child poverty, and that's really admirable, and I get that. So why don't you do more? Why don't you relieve VAT, allow VAT recovery for charities engaged in child poverty or any poverty, quite frankly? The growth of the third sector, again, has been massive, and that's picking up the issues with the public sector. So it's a part of our DNA almost. So why are we taxing essentially charities by disallowing VAT recovery? So give them a refund mechanism. We can do that, and it wouldn't be massively expensive. The revenue raised £1 billion in penalties 2 years ago. So maybe just flip that into charities and pay some back. That would be really nice to see.
So I don't think they've quite gone far enough within this budget.
I don't think they have. I think there's more they could do. There was a lot in this budget, though, and there's a massive information, but I still think there's more they could do that would be constructive rather than destructive.
Okay, thank you, Sean. And whilst not specifically related to VAT, what can you tell us about the new duty for electric vehicles?
Yeah, so obviously, as they're phasing out, I guess combustion engines, they're looking to need to replace that revenue, which is significant. It's absolutely significant. Yeah, so how do you do that? I think that the first thing they've come up with, and this is a pathway for me for taxation because it's going to increase. It's got to. There's no other game in town really for this. So there's a mileage charge for EVs, 3p per mile from 2028 to 2029. Interesting, as we discussed, how do you actually capture that data for how much mileage people have done? And that then leads into all different issues. And MOTs were mentioned, but that's after 3 years of use. And people, I'm struggling to see how they do that without some kind of Big Brother tracker. And that might help people clocking cars and things like that. So other issues, but it's an interesting policy, but something has to be done. The next piece is there will be a consultation on vehicle excise duty for EVs as well. I think that's was always going to come. And if there's consultation, it's good news. And there is also a benefit in kind easement for hybrids, which again, I think is just recognition that something needed to be done there. So yeah, a mixed bag, but I think that's one to watch really.
Okay, thank you. And for those that don't know Sean, he is a bit of a lover of motorized horsepower. And talking about horsepower, therefore, what's happened with gambling duties and online gambling duties?
Yeah, I think it's interesting. I think again, this is a piece in evolution because we've seen the increase in sponsorship, the increase of these apps again. They are literally everywhere. And I think a bit controversial morally in terms of some of the damage that gambling addiction, things like that can do. There has been an increase to raise revenue, obviously, given the amount of revenue going into these companies. So that duty rate has gone up from 21% to 40%, which is significant. There's a lot of pushback from the sector prior to its positioning, I guess, around job losses in the sector. But I think that was almost inevitable. And I think the next piece will be beyond tax, will be about advertising and placement and enticement. That piece is bound to follow like tobacco advertising, really.
Yeah.
There's a general betting rate rise to 25% from 15%. But there's an exception for UK horse racing, which will remain at 15%, which again is quite niche. But again, for those who are gambling or in the sector, it's going to be important.
Fantastic. And Sean, before we start to wrap up, was there anything that you expected to perhaps hear in the budget that didn't materialise?
I think One thing was fuel and power. There was a kind of mooted that we might get a removal of the 5% reduced rate for that domestic fuel and power. And I think if that had been done, I think it would have gone a long way for the government actually in terms of PR. There have been green levy changes, which is good news. But I think for me, when you look at tax, it needs to be some morality behind it, which sounds a bit odd probably from a tax advisor. But actually, I think that you shouldn't really be taxing fuel and power. It just feels wrong to me on consumption. And I think that should be addressed. It should go. It's controversial when it came in. It's reduced down to 5%. I think it needs to go full stop.
Okay. And I suppose from my point of view, things that we were perhaps expecting, we were thinking that they might have tried to align capital gains tax rates with income tax rates. Fortunately, they haven't. They've just given us 3 extra income tax rates. We did think that there might have been an exit charge for people wanting to leave the UK for countries where the tax regime is perhaps less penal. That hasn't occurred. Overall, was this a good budget? Did it help any of us, particularly the entrepreneurs? The press media seemed to think that this was, perhaps a fair budget, but did it offer anything for investment, for growth, for business? I don't think it did. It was interesting as well, a lot of the measures announced don't actually start to kick in until towards the end of the government's current period of tenure. And therefore, will they start to maybe think about reversing some of these decisions the year before the election? I don't know. Do we think Rachel Reeves will deliver the next budget? I think she probably will. I don't think this was a budget that was too outrageous. Everybody's got to pay a little bit more, which is what they promised. They haven't raised the main income tax rates directly. They've done it by stealth. The question is, will there be more tax rises in years to come? I'm not too sure what else they could raise or change, but they do still have a black hole to fill, even though they've given themselves some fiscal headroom this year. We've now come to the end of the formal bit. There are some questions in the chat, and I'm just going to go and click on that. First one is, Sandra, you mentioned the 2% rise on dividends and interest. What's happening with ISAs, and is that going to impact taxpayers and savers?
Yeah, it's an interesting one. Richard, the Chancellor confirmed that cash ISA limits will be reduced to 12,000 a year from April 2027. So the key takeaway here is if you are over 65, then there will be no change. The 20,000 cash ISA limit will continue to apply. But if you're 64 or under, the cash ISA limit is capped at 12,000. Now, what this is aiming to do is it's encouraging people to invest in equity, so equity ISAs. You still get tax relief. It's just a different way of investing. Now, is this going to have an impact? I'm not sure. I mean, from an income tax perspective, you're still, even if you sell equities that are wrapped up in an ISA, you don't pay capital gains tax, and the same with any interest on the cash. She's just encouraging people to diversify and claims that it'll be much better.
Okay, this is one for the floor that says, are there any changes to EIS, CGT, reinvestment relief or loss relief?
Not that I've seen yet. I don't think there are any rate changes around EIS. They're mainly around broadening the scope of the companies that would qualify. So I need to get into just double check the detail, but I don't think they've changed the rate on that. They have on VCT, as you mentioned, but not on EIS, I don't think. Okay,
and I've now got 2 employee ownership trust questions. First one, it says that I've been told my company, actually no, so I've been talking to my solicitor about selling the business to an EOT. Do I need to put that on hold? That's the first of the EOT questions, and maybe Ian can answer that one.
Well, the changes that were announced are effective from budget day yesterday. So I believe it relates to transactions from yesterday onwards. EOTs were something they introduced 10 years ago, more than, to try and encourage companies that didn't want to sell to a third party to sell to their employees, a bit like an extension of the M&S model of employee ownership. The headline is that you could get 100% tax relief for selling your or more than 50% of your shares in your company to your employee trust. Various other changes over the last couple of years, but the reality they've cut that to 50% relief now. So I think it's certainly, you need to stop and pause. You may have missed the boat already, but you need to speak to advisors. There may be a better way.
So following on from that, there's another question as well in the chat. So we concluded our EOT in June 25, so are receiving our income via loan notes, which are currently 100% tax-free. We understand Rachel has reduced this down to 50% tax relief and have read it affects EOTs from October 24. Does that mean there is retrospective change for us now? EOT income is now going to be taxable?
So I haven't seen the reference to October 24 myself yet. Retrospective tax changes are thankfully rare. As far as I believe, it's from transactions after budget day, as I said. But again, I'll get back to that questioner just to confirm the details.
Yeah, I've got the sender's details for that one.
Okay. Yep.
And then the final one, I've been told that my company wouldn't qualify for an EMI scheme as I've got about 300 employees. Will I now be able to reconsider this?
That me again.
Yeah, sorry, you've got all of these in, unfortunately.
So EMI, say one of these acronyms, share options for key employees to try and give them share ownership in the company. One thing, it's always good if you've got people who want to give shares to any company, the advice is normally don't give them shares. If you may want to give them some ownership, give them options. It's a bit of a promise, but you're not committed. So it's always good to try and avoid giving them shares, although that's normally the easiest to understand. Share options are something that you want to look at, and that's where advisors can come into play. The couple of quick main changes in EMI is that they basically extended or doubled a lot of the limits. So you used to only be able to offer it if you had less than 250 employees. They've now changed that to 500 employees. So the questioner may be within that range. There was a gross assets test of 30 million. That's gone up to 120 million. So again, I suppose the point to take away is that you may have not been able to take this up before because of the size and the type of company you've got. It's worth a look. One other quick thing on EMIs is that there was always a 10-year qualifying period for EMI options, and they sort of lapsed. So the idea was to get it done and dusted within that 10 years. They've now extended that to 15 years, which will be for new options granted after the 6th of April 2026, but it also does apply, I believe, to existing options that haven't yet passed their 10-year window. So if you do have an EMI option scheme, speak to advisors or your friendly team at UHY and we can help you.
Okay, thank you, Ian. We haven't got any more questions that I can see unless anybody wants to ask something live. I don't know if Timon can open the microphones. If anybody wants to ask anything live to the panel, we'll try that. We know we have gone past the deadline of 12:45. So if there are no questions, we'll probably wrap up and say thank you very much to everybody for attending this afternoon. We hope you found it informative. And if anybody does have any questions afterwards that they want to address to us, please feel free to drop us an email, and we're only here to help you. Thank you very much, everybody, and thank you to the panelists as well.
Yeah, thank you.
Yep, thanks.